Every great empire has believed itself exceptional until a silent pattern led to collapse. Spain's gold-fueled power vanished after 4 shocking bankruptcies. Britain's global dominance unraveled as sterling broke, then faded. The Soviet Union disintegrated in under 900 days. Now the United States faces a 5th stage, with mounting debt, shrinking industry, and fraying trust. How close are we to the point of no return, and what hidden signals could reveal what is coming next? Gold and silver from the New World poured into the Spanish treasury, filling royal coffers and dazzling Europe with displays of power. Yet behind the spectacle, the Crown's finance ministers faced a problem they could not solve. Earl J. Hamilton's research shows prices in Castile more than tripled between 1500 and 1650, even as shipments of bullion reached record highs. The riches that should have secured Spain's dominance instead fueled relentless inflation. To pay for endless wars and mounting debts, officials began debasing the copper vellon coinage in 1599, quietly reducing its value while keeping its face unchanged. 4 times, in 1557, 1575, 1596, and 1607, the monarchy declared bankruptcy, each time hoping new treasure would reverse the tide. But real wages collapsed, and the price of daily goods soared beyond reach for most. The illusion of wealth hit a hollow core. Spain's money lost credibility long before its empire lost territory. Hamilton's data revealed the truth. When currency becomes a tool for survival, prosperity vanishes. Britain's imperial reach once circled the globe, but its decline unfolded in slow motion, shaped by decades of financial strain and institutional choices. After World War I, the Treasury faced a mountain of debt and a weakened pound. In 1925, the Bank of England restored the pound to its pre-war gold value, a move that overvalued the currency and stifled exports, deepening economic stagnation. By 1931, the May Report warned of unsustainable deficits, and Britain was forced off the gold standard, exposing the limits of its fiscal resilience. The Second World War magnified these pressures, leaving the country dependent on American loans and facing chronic trade deficits. In 1947, sterling's promised convertibility to dollars lasted just weeks before the government halted it, admitting the pound's diminished power. Paul Kennedy's thesis on imperial overstretch captured this reality, that global commitments outpaced national means. The erosion of sterling's reserve status set a precedent, showing that even a managed descent can leave lasting scars on a nation's economic core. By the mid-1980s, the Soviet Union was devoting up to 17% of its entire economic output to defense, a burden far heavier than any Western rival. Factories built tanks and missiles, while grocery shelves sat empty. The Communist Party's rigid command system, once a source of stability, had become an obstacle to adaptation. Reformers like Mikhail Gorbachev tried to open the system with perestroika and glasnost, but these efforts only revealed how brittle the structure had become. Internal debates, later documented by historians Stephen Kotkin and Mark Harrison, show leaders arguing over whether to cut military spending or risk losing control. The bureaucracy could not agree, and the country's supply chains began to break down. In just about 900 days, from the first cracks in late 1989 to the final dissolution in December 1991, the entire Soviet apparatus unraveled. The collapse was not gradual. It was a sudden, total failure of a system stretched past its limits. When institutions cannot adapt, collapse can be swift and absolute. Federal debt now stands above $34 trillion, with the ratio to gross domestic product nearing 130%. Congressional Budget Office analysts warn that this trajectory is not a temporary spike, but a structural feature, driven by persistent deficits and rising interest costs. Interest payments alone are set to outpace all other federal spending within a decade, crowding out funds for infrastructure, education, and research. The burden is compounded by a shrinking industrial base. In 1979, nearly 20 million Americans worked in manufacturing. By 2025, that number has fallen to about 12 million, erasing more than a third of the sector's workforce. Data from the Bureau of Labor Statistics and UNIDO show the United States' share of global manufacturing output has slipped below 18%, down sharply from its post-war peak. Once vital industrial towns now face shuttered factories, empty warehouses, and dwindling tax bases. For many workers, the promise of stable, well-paid jobs has faded into memory. The numbers reveal the underlying weakness. Debt accumulates as productive capacity erodes, leaving a hollowed-out core beneath the surface of national strength. The Pentagon's global reach now stretches across 750 to 800 military bases, each one a node in a network that demands constant funding, attention, and manpower. Annual defense budgets exceed $800 to $20 billion, but the true cost lies buried in decades of overseas commitments. Since 2001, direct spending on wars in Iraq, Afghanistan, and related operations has surpassed $8 trillion, a figure that does not include the long-term obligations for veterans or base maintenance. Sustaining this presence absorbs resources that once fueled domestic investment and industrial renewal. Internal government reports estimate annual upkeep for these bases at $150 to $300 billion, a burden that grows as new threats and missions emerge. Meanwhile, Treasury International Capital data reveals a slowdown in foreign purchases of U.S. government debt, a subtle but critical warning. As global investors hesitate, the cost of borrowing rises, forcing the country to divert even more resources just to keep the system afloat. Each new deployment, each base expansion, adds weight to a structure already straining under its own commitments. Trust in American institutions now sits at a historic low. Pew Research Center surveys from 2024 show that only about 1 in 5 Americans express confidence in Congress, the presidency, or the courts, a collapse from the near 70% levels seen 50 years ago. This loss of faith is not abstract. It touches daily life in places like Lordstown, Ohio. After the General Motors plant shut its doors in 2019, more than 4,500 workers lost their jobs. The ripple effects hit the entire town. Local diners closed, tax revenues fell, and the school district was forced to cut programs. Civic leaders who once organized parades now scramble to keep food banks stocked. The pain of economic loss quickly became a fracture in social bonds. Nationally, polarization has reached record highs. Surveys chart a steady rise in partisan animosity. Americans are more likely to see political opponents as threats than as fellow citizens. The numbers reveal a society struggling to hold together. Trust in neighbors, local officials, and even basic facts has withered. As the fabric of shared identity frays, the institutions meant to hold the country together grow brittle, leaving communities like Lordstown searching for stability in a world that feels increasingly uncertain. IMF statisticians track the dollar's share of global reserves with quiet precision. For decades, the baseline hovered near 60%, a level that signaled confidence in America's financial system. Now, the latest COFR data shows that share slipping, 57.7% in early 2025, with the risk of breaching the 55% threshold that reserve managers consider a warning sign. Central banks watch for patterns, not headlines. 4 consecutive quarters of net foreign selling of U.S. Treasuries would trigger internal alerts, signaling that the world's safe haven is no longer immune to doubt. In the past year, China's holdings of treasuries have dropped to $730 billion, down nearly half from their peak. Meanwhile, gold's share of official reserves has climbed above 23% as central banks quietly shift away from dollar assets. The BRICS rail share in global payments remains small, but its steady rise hints at a search for alternatives. Credit default swap spreads, once an afterthought for sovereign risk, now flicker as early warnings on trading screens. These metrics, tracked quarter by quarter, offer the first quantifiable signs that the dollar's privileged position is vulnerable to erosion. Deep, liquid capital markets still anchor the American economy. Every day, trillions of dollars move through U.S. financial systems, providing a level of stability and flexibility unmatched by any rival. Technology and research remain powerful engines of renewal. U.S. firms lead in artificial intelligence, software, and biotechnology, holding the world's largest portfolio of intellectual property. The CHIPS Act, signed in 2022, aims to rebuild domestic semiconductor production, signaling a commitment to restore critical supply chains. Demographically, the United States stands apart from other advanced economies. A steady flow of immigrants helps sustain a growing workforce, while countries like Japan, China, and much of Europe face shrinking populations and rising dependency ratios. Energy independence, achieved through the shale revolution, reduces the nation's exposure to global supply shocks that once crippled earlier empires. Alliances, NATO, the Indo-Pacific partnerships, and long-standing economic ties give the U.S. diplomatic and security depth that neither Spain, Britain, nor the Soviet Union could match. These structural advantages do not guarantee immunity, but they offer levers for adaptation and recovery that history's fallen powers lacked. Today, the world's reserve currency faces its steepest challenges since 1944. As debt and division rise, no empire has ever reversed stage 6 once it begins. The next chapter is not written by history. It is shaped by choices made now. The pattern waits for no one.